Hey guys, I'm Savannah Beer with the Beer team. Austin, my husband, and I are full-time realtors. We work in Elkhart County and Kosciuszko County, and we've got Amanda Newland here with us today to talk about what's happening in the real estate market from the lending side of things. So Amanda, can you tell us about yourself, and then we'll jump in?
Yeah, sure. So again, my name is Amanda, and I work with Hometown Mortgage, and we actually are powered by Cardinal Financial. So Hometown is a local branch of Cardinal Financial, and we help people get into homes. We find the perfect loan program for them, and so they can go out and buy their first home or their second home or the home of their dreams.
Okay, sweet. Well, thanks for coming to my house and having a cup of tea with me. And
yeah, it's a pleasure.
Yeah. Okay, so let's just talk about the basics of what you do. What is a mortgage loan?
So essentially you're buying money, right? So you can't buy a house without a significant outlay of cash. And so what we do, a mortgage loan is just that. It's a loan that provides you the ability to have a mortgage on a home. So some people, it's just called a mortgage loan, a note. It's just the money that you need to buy the home.
Okay. And is there just one type of mortgage loan, or tell us about the different types of mortgage loan?
Oh, there's so many. Typically speaking, there's four, right? So there's the three government loans like FHA, VA, and USDA, and then conventional loans. And then within those four programs, or those loans, there are programs within those, sub-programs, if you will. So like grant programs and down payment programs, those kinds of things.
Okay, so it's a lot, and they should talk to you to understand all of the options that they have.
Yeah, I think that there's this idea that I'm going to go get a loan and it's a one-size-fits-all, and if I have good credit and I have a little money or whatever, I'll just go get the loan. But it really is so custom tailored to every situation, because ideally we would say, a conventional loan is kind of where everybody should be, but maybe not necessarily. So my job when someone comes to me is to do a consultation and then find out what their long-term goals are for this home or for a home in general, and then help them make the best decision for that program so that we get them into the one that makes the most sense for them.
Sure. Now, who can get a mortgage loan, and how does credit play into that?
Way more people than think they can. I think we sometimes think of homeownership as like this very adulty, way out there in the future thing. And we see our parents or whatever have homes and it seems so unattainable. I think especially for early 20s and things like that, it seems like there's no way we could buy a home. And that's just not true. If you're of buying age, there's probably a program for you. Sometimes people are afraid. They're afraid to even ask the question because they think they know the answer, or they don't want to be told no. But very rarely am I in a situation where I say it's just not going to happen. Sometimes what we say is it might not happen this month, but we can get you to a place where it can. I think homeownership is a very attainable goal, and it is the best way to build wealth, sustainable wealth. And I don't mean like being Bill Gates, but I mean like owning your own thing. And when you rent, you're pouring money into someone else's equity, and for young people especially to understand that is within their grasp to build that sustainable growth over time is not something we talk enough about, I don't think.
Yeah, it's like a savings account.
Yeah. Really, yeah.
Is it true that you have to have excellent credit to buy a house?
No.
Okay,
no, you don't have to have excellent credit. So credit kind of goes poor, kind of okay, good, exceptional. And I would say, if technically speaking, we can loan somewhere. I specialize, and my company specializes in subprime credit, which just means that we will and can lend to a lower credit than a lot of places and people. But that being said, more programs and options open up to you, the better your credit is. Sure. So I would say if we're looking for a number, right? So when you hit 600, things start opening up to you. When you hit 700, you have a lot more options. And if you're over 720, 740, 750, you start getting in those upper sevens, then the sky's the limit.
You're in a good spot.
Yeah,
okay.
yeah. So I would say your goal is that 600, but I would also say don't let that stop you.
Yeah.
Like, it's better to have the knowledge. And one of the things that I offer is credit repair. So you can come to me, we will pull the credit, we'll actually sit down and look at the credit report together, and then I can run a simulation and we can say, if we do XYZ, how long before I'm at a place where I can loan.
That's awesome.
Yeah.
So let's switch gears now and talk about interest rate, because that's the thing that everybody's talking about right now.
It is.
What have we seen over the last 2 years when it comes to interest rate?
I know for me personally, the recent interest rates going up have been a big deal. So interest rates is really, I think, helpful to think of it long term, like to really put it in perspective. And we kind of describe it in peaks and valleys, but that implies like a smooth, but it's really not. It's like an EKG going crazy, right? So it goes, the rates will go up and down, up and down, up and down in little increments, trending up or trending down. And then from peak to peak, at its height to its height, it's usually somewhere around 7 to 10 years. And we just saw like this valley that was like incredibly low. And I think in some ways that kind of artificially put in people's minds who were coming into home buying age and who were like refinancing that is the norm. And that absolutely is not. So when we were refinancing people at 2% rate, you know, that was a permanent rate. No one's going to refinance that. So what we're seeing right now are what would we consider temporary rates. If you don't sell out of that house that you're buying at a 5%, you're probably going to refinance at some point. So rates are higher, but they're definitely not high.
Let's put it into perspective. I know we were talking right before this about when you bought your first home. So what did you buy your first home for?
So I bought my first home at 13% interest. And I think about that now and I think, man, and 100% financing. So like no down payment. I rolled all the closing costs in. So like we walked out with so much debt that wasn't necessary. And that was in 1996. But even as recent as, 2005, right before, everything happened in 08, or I would say even the rates we're seeing right now were rates we saw 4 years ago. So they aren't high. They just look high in comparison to
what
that bottomed out that we saw during COVID.
I believe that the 20-year average, so for the past 20 years, the average rate has been 6%.
Yeah, and that's totally, and when you're talking peaks and valleys, that's sitting right where it should be. And right now we're seeing that, and it's going to continue. I think we're going to continue to kind of up and down and up and down and up and down, which is why I think it's so important that people don't think, well, what I'll do is just wait for it to bottom out again.
That's a big thing to note.
And if you're going to wait for it to bottom out, your buying power is going to continue to decrease. Because, and you and I were talking about this, a house payment, buying a house for $150,000 at a 3% rate, your payment's going to be lower than at a 6% rate. And we know that. But I think it's so important to get all the information. That's why really before you start to go look for a house, you have a consultation with a lender, specifically me. But you do it because you have to have all that knowledge and you don't want to go into things blind. And the market is like super hot.
It is. It's competitive.
To not know what you can do is kind of silly right now.
You would want to know before. And this is a good plug for our first-time homebuyers class this upcoming week on Tuesday, April 5th, right?
Yes.
Okay, from 5:45.
That's it.
5:45 to 7. It's going to be at the K21 Health Pavilion in Warsaw. It's free. We're going to provide you with free dinner. Amanda's sponsoring it, so thank you for providing us with free dinner.
You're welcome. I'm excited.
And we're going to talk about everything you need to know to buy a home for the first time, because you want to be prepped so that when you say, yes, I'm ready to buy my home right now, this market's crazy. People are, as soon as a home gets put on the market, you can expect it to be under contract within 3 to 5 days, depending on the price range you're looking at. But for a first-time home buyer, really it could be anywhere from 24 hours to 48 hours to to 72. Yeah, it's more of that.
And I would say don't be me. When we bought our first house, I didn't know anything. I didn't know what made up a mortgage payment. I didn't understand escrow. I didn't know how county taxes played into anything. I didn't understand my rate. I didn't understand my program. We just didn't know enough. And if I could go back and tell my younger self anything, it would be to be informed. So I'm so excited for this homebuyer class because I feel like what a great way to like really understand what you're doing and be prepared and go into this market and go into looking for a home like knowing what you can do and feeling empowered and feeling like
knowledge is power,
right? For real. So I'm super excited about it.
Yeah,
glad
me
for the
too.
opportunity.
That's awesome. Thank you. Okay, so the last thing we're going to talk about here is kind of the hot topic, the housing bubble. Everybody's concerned about a housing bubble because we have seen home value appreciation that is historic really over the last couple years. It was from 2020 to 2021, I believe the home value appreciation was at 19%, when historically speaking, the average is like 3 to 5% home value appreciation. And appreciation just means the home value increasing, growing. So let's talk a little bit about that. I know a couple of things that I want to mention. Because of the extremely low interest rates that we've seen, that has minimized or lessened the effect of the incredible prices because you're going to pay, if you buy a $200,000 home at 6% interest, your monthly payment is going to be about the same if you buy a $250,000 home at 3% interest.
Right, exactly.
That's a $50,000 difference. That's so
it's a lot of house.
It's a lot of house, yeah. So where you keep hearing, if you hear it's a seller's market all the time, it is a seller's market, and it will become more so now that interest rates are increasing, but really it's been a buyer's market too because interest rates, and even now, I mean, interest rates are so competitive. It's such a good time for buyers. It makes homes more affordable. And it's still so affordable, especially when you think of your first home at 8%. Austin's parents bought their first home at a credit card interest rate, like 20%. So, so yeah, it's still a great time to buy a house. And the difference, when you hear housing bubble, we automatically think of the most recent 2008 housing bubble crash.
Terrifying.
The big difference is the cause, right? So in 2008, they were lending, right, to people who talk a little bit about that. Tell us about that.
One of the big things that came out of that is the ability to repay. And as a lender, my philosophy is that I want to do what's best for you, because just because you can doesn't mean you should. And I think the philosophy part of that 08 was, how much can I do? Well, they were just giving people loans, and then those people did not have the ability to repay them. Loans were being called in on adjustable rates and all of this kind of stuff, and people really just could not afford their homes, and it led to all those foreclosures. And
the adjustable rate, mention that a little bit.
So adjustable rate, we don't even do. Like I don't do adjustable rate mortgages.
I don't think I have personally. I've been in real estate for 6 years and I have never dealt with an adjustable rate mortgage.
And part of the reason is because the fixed rate is so low. But if anybody ever tries to put you in an adjustable rate, that means they put you in a low rate and then it's going to adjust after a certain period of time up to a certain amount. Well, if you're used to paying and you're on a certain mortgage payment and then your rate goes up by 3% or whatever, it makes a huge difference, and that was part of the issue. But we don't do that, and the rates are fixed, and I'm just that whole, just because you can doesn't mean you should. So just because you can afford $2,000 a month on a house payment doesn't mean you should. Like you really need to look at the whole thing.
Picture.
And as part of being a responsible buyer, and taking your whole lifestyle into consideration.
And you help people do that. You help them see
absolutely.
the big picture.
And I, at the end of the day, I can't tell you if you're ready to cut out your Starbucks habit, to afford a home. Like that's up to you. But it is part of my job and a privilege to say, how do you want to live? Like how much of your house do you want to be a part of what you're doing? And so this housing, the idea of people having houses they couldn't afford, that's what we try to avoid now. And we really watch the debt to income ratio, which is something we'll talk about at that class, and how much of your house is part of your debt, and are you okay with that?
What we're seeing now, it comes purely down to supply and demand.
Oh yeah.
Because homes stopped being built for 5 years after 2008.
Okay.
Demand has increased, but supply just hasn't been able to catch up. And then with the pandemic, that intensified things because everything shut down. Homes stopped being built for a time, supply chain disruptions, cost of materials.
And we're seeing that now in new construction.
Yeah.
Like, you can buy way more house than you can build right now.
Mm-hmm. Absolutely. So there's a big difference there. I think when people hear there's a housing bubble, I don't necessarily think there is a housing bubble because it just comes down to supply and demand.
Right.
And when you look at what we're seeing now compared to what we saw 15, 20 years ago, interest rates are very competitive, historically speaking. And so don't let that intimidate you or stop you. And we live in an area with so much industry,
right?
Which intensifies the supply issue.
It does. It does, and the more that gets built, the more it intensifies. But I think that's why it's so important for people to, this is the internet age and like everything, right? So Zillow, I mean, it's like a hobby.
Yeah.
But that's why it's so important for them to have good partners, for people to have good partners, to have a realtor team that really knows what they're doing, because by the time you see something on Zillow right now, it's gone.
Yeah.
And by the time you try to schedule your own showing and then like really negotiate and write an offer, like that, you need experts. So that's why they need you.
Yeah.
And then they need a good partner in the lending side, because it really is a 1-2 punch. Like, to get a home right now, when you see something, you have to be ready to jump on it.
Yeah, you need a solid team behind you.
Yeah, that supply and demand is crazy.
Yeah.
And people have to be willing to put some time and effort into it.
Yeah, absolutely. Well, thank you so much for coming and
it was
talking.
Fun. I enjoyed it. I'm really looking forward to our class.
Yeah, me too.
I'm really looking forward to that.
Me too. If you guys have any questions, feel free to message us. Amanda's contact info will be included in the comments, and our contact info too. If you guys have thoughts or questions about this video, feel free to reach out and let us know.
Thank you.